So here on this graph, we have our total revenues from year 5 to year 15. For each year up to year 11, we had a steady growth of about 100,000 a year, which, was awesome because we were all about making money. And then in year 12, we had a dip, which wasn't, which was okay because it was minute. It wasn't that much. In year 13 and 14, we had another dip. But what's crazy is that year 15 was our highest in total year revenues, at over 1.1 million. But some of the other figures that we have showed kind of a different story when it comes to year 15. If you go back and you check the numbers in year 15, it actually was one of our highest gross selling products, units in cameras, not drones and cameras. So we sold a lot of cameras in year 15. We just didn't sell a lot of UAVs, even though we controlled in the camera market in year 15, we controlled over 25% in almost every single market segment. And in the UAV drone, we controlled all market segments besides one. So in year 15, and then we have our dreaded year 11 between year 12, which you'll see here shortly. So earnings per share, we had a steady growth of about $1 to $1.50 all the way up to year 11. And then we have our dip, and that's where something went wrong. We didn't know what it was. We were confused because we were riding high on being tied in the top 100. And I think we started overthinking things, and that's where we started going wrong. We started overthinking things. So, in year 12, we went down. In year 11, we were at $12, and then year 12, we're at $8.66. Well, we brought it back up in year 13, and then year 14, and then year 15, there's a significant drop again. Then again, you have, $7.62 at earnings per share. But then again, our total net revenues was over 1.1 million. So the numbers, are there, but they're not there. And then our return on equity. So we started off in year 6, we were in the top 100 in return on equity. We were all happy. We were somewhat, since it was so new, we were trying to figure out what we did to try to be able to sustain that. I don't think we ever could truly figure out what we did on that return on equity to be able to be that high. I think we were all still new about it and confused about it, and there was a lot of things that all of us did not know. So you see the considerable drop between each year to year. So we went from over 50% to being over 40, to being under 40, roughly 35%, down to 30. Then we were under 30, and we just kept dropping down and down and down. And then you see that significant drop between 11 and 12. So that was the years that we should have started selling our stocks and being able to buy them back. And that was a huge mistake that we made as a team, because we personally, and we didn't feel like selling our stocks would be beneficial to us, but we were wrong, and we believe we were wrong. We also made other decisions to add robots into our facilities, and that was a mistake too. We should have paid our employees a higher wages instead of doing that. So I think that we believe that those are things that hurt us in the last 3 to 4 years of the simulation. And you can even see the drop in our stock price, because you can start at year 6. You can see how we grew it all the way up to year 11. We were at 336.82 cents, and then all of a sudden we got cut in half right there in the year 12. It was such a significant blow. I think all of us were in shock, and we were trying to scramble to figure out what we did incorrectly to lose that much. And in a way, it was kind of defeating, but we all stuck together to try to figure out a plan to reinvent the wheel and make everything work correctly for us. But I don't think we ever truly grasped what we needed to do until it was too late. And by then it was too late. There wasn't anything we can do about it, because our stock dropped all the way down to under $100 by year 15. Even though we had a significant total revenue in year 15, but our stock price was significantly low in year 15. In our credit, our image rating, we wanted to try to increase our image rating every year. And you can see the trend was always upward besides 1 year, 2 years actually, where we dipped down in 10 and 11. So we figured out that, you know, sometimes your image rating along with making money, it goes kind of hand in hand. Sometimes your image rating have to be low for you actually to make money. So you can't have the highest image rating and expect to have the greatest returns. So that's why our image rating in year 15 is 91. I believe if our image rating was more of an 80, then maybe our numbers would be different. We strive to have an A+ credit rating through the entire simulation, which we actually almost did that. We started in year 8 and made it through year 15, which I think that a lot of that was because of some of the things that we did, and not selling our stocks and didn't take out any loans. And we paid off one of the loans for installing the robots early. And I believe that that's why we were able to establish that A+ rating. And then our vision statement here at Elite Electronics is our vision is to be the best leading brand in the digital camera and UAV industry by offering the products and equipment of the highest quality at affordable prices. We also want to offer products to those with a passion for capturing all of life's important moments through our lenses, not our competitors.
Our performance targets for the next couple of years, for next 2 years, we would like to set up a goal as a 876 and for year 16 and 986 for year 17. On return on equity, we realized that we are being realistic, and we would like to get slowly, gradually improve our return on equity. And for year 16, we'd like to be 11%, and for year 17, we're aiming for 13.5%. The same with the stock price. We would like to have a more slowly improving our stock price, and in year 16 we plan to be at $115.55, and for next year we would like to see a stock raise to $120.55. The graph here for that same thing. So let's see this increase slowly, but I'm making sure we have a steady progress. For performance credit rating, we like to continue our trend to past couple years, 8 years, where we had a credit rating with A+ for both year 16 and year 17. And also we'd like to have our image rating as high as possible. Of course, the next year we set up a goal as 92, and the year after 17 we aiming at 94.
So with our competitive strategy and action capture cameras, our focus was to make quantifiable goals and track our progress to grow profitability. We used a combination of strategies within each region to allow us to be more flexible with our decision making and to maintain high image rating and gain higher market shares. In order for us to manage our company, we had to do the following: closely monitor the market share between our regions. Oh, I got my faces in the way. To make sure we maintain control. I'm sorry, hold on a second. Moderately increase our production and sales to stay ahead of our competition, increase our total profits as much as possible to have successfully sustainable products, modify the design of the AC camera, and offer sales promotions frequently to allow our products to reach more customers. And with the outcome, our goal was to maintain 15 to 20% of the market share in each region. We were able to successfully reach that goal. In fact, we earned more than 20% in each region after year 8. By monitoring our competitors' PQ ratings and prices in the market, we were able to develop high quality cameras at an affordable price, and our PQ rating was average. Providing special features to our, Providing special features to our cameras was a way we were able to employ a global differentiation strategy that set us apart from our competitors. Once we started adjusting these features, we were able to do more advertising, provide longer warranties, promotions, and discounts. We were able to increase our net profits by reducing labor costs throughout the years, but continue to struggle with our return on equity. Similar to our competitive strategy for AC cameras, we use a variety of strategy with best cost being strategy of our main focus. We aim to give customer drones that satisfy their expectations and were reasonable. We believe by utilizing this strategy, we would be able to sell to a larger number of customers, which we could widen our share in the UAV drone market. We began increasing the warranty period and differentiate the offer to third-party online retailers. We start marketing each individual region as its own entity while learning that certain regions had significant exchange rates that we had to target in our marketing decisions. Whenever a region had positive exchange rate, we typically targeted the region with specific discounts and offers to increase sales. And if a region had negative exchange rate, we would offer bigger discounts to encourage sales. So throughout the years, we started identifying and communicating our strengths and weakness with cost allocation and realized we needed to make improvements as we cope with challenges that impacted our company. Once our competitors started adjusting their production expenses and marketing strategies, competition became more intense. We were making changes in the production line and in marketing segment, trying to avoid negative impact of the driving forces, but we failed because we increased our production costs and didn't increase cameras. So basically, we should have just done a better job shifting resources from one area to another to better support our strategy execution efforts.
Here at Electronics, our production strategy, we like to have our AC cameras and drones affordable and reliable to our customers. Also, be able to have sure our customers satisfied with our products, and we will maintain PQ rating of 5.0 and above. We finished the simulation with EA15 with 5.1 PQ rating for AC cameras and 6.8 in the UAV drone segment. Electronics, should have shifted resources from one area to another, provide more support for strategy execution efforts. The first couple of years, we were able to adapt quickly and meet our needs of our customers and change the industry, increase our return on equity by 37%. We had to raise the price of our products and put our resources towards sales and promotions while reducing labor costs and operation expenses as well. We had to reduce the price of our cameras and drones to sell more by shifting resources from cost to increase productivity. Here at Electronics, we try to properly handle staffing issues, and due to the whole simulation, we're able to provide great benefit package. But year 10, we installed robots to help increase productivity that basically hurt us. We was employed because we didn't provide enough incentive package, incentives to stay with the company. overall, we weren't able to provide to manage staffing issues appropriately. That was one of the reasons we finished last in the competition.
Our finance strategy was kind of funny. The way that we put it together is, we wanted to make as much money as we could without selling our stocks. And by going out about it that way, we believe it was one of our biggest downfalls. Is that when our stock was high, we should have sold. We should have sold our stocks when we had the opportunity, because we would have had the opportunity to buy them back. And that was one of the biggest things that we did incorrectly, was not selling our stocks. And I believe it, and we all believe it. And if we had to do it all over again, and even for the next 2 weeks we would definitely sell our stocks and be able to buy them back, because that was one of the biggest mistakes that we made in this simulation. And I think that's one of the things that hurt us the most, was we got greedy. We didn't think that we needed to do it, and it was an absolute mistake.
Taking a look at our closest competitors, if we're focusing on the AC camera segment, I would say our closest competitor would have been a competitor or Company A, the Aphrodite Camera Company, for a few reasons. First reason is they had a very similar demand as us. We had a demand of 423 cameras in year 15, and they had a demand of 402, which is very similar. We offered the same discount of 40% off as Company A did. We also held a very similar share of the market as Company A. We had 26% of the market share in year 15, and they had 24.8%. We sold more products than every other company, but Company A was a close second every single year. And if we're looking at our closest and strongest competitors in the UAV drone segment, I would say our closest one was probably Company A again. Company D was probably the strongest, but Company A had a lot of similarities to us. One of the main similarities would be the market share again. We held 24.5% of the market share in year 15, and they had 23.9%. They sold a very similar amount of drones as us. We sold 104 drones in the final year, and they sold 101 drones, which was very close. They also had a very similar number of online retailers as we did. We had 52, and they had 53. But Company D strong held a 7-point performance in the last. They had a strong. If we had 2 more years to beat out a Company A or Company D, we would have to continue adapting to the exchange rates to increase our margins of profit, because the exchange rate is one of the most important detriments to be able to see how healthy a country or region is economically. So it's really important that we locate that and we focus on those regions. Our company would also reach our new goals in equity and stock prices. Like Martin said, we wanted to reach 13% in equity and keep that growing. We would also want to increase the rate of pay for our workforce, because increasing the rate of pay to your employees will benefit the quality of your products, and it will benefit the overall workforce in general. And continuing on, if we had a couple more years, like Steve stressed, we would have definitely have sold our stocks, and then we would have bought them back in year 17. And when you sell your stocks and buy them back, it gives you a lot of cash that allows you to pay off debts, or even donate to different charities. And we would have continued to increase the performance quality rating of our products because we always tried to stay closer to 6 stars. Obviously, we didn't stay there the entire time, but we wanted to be closer to 6. So we would try to get that closer to 6 stars. And we would have invested in the facilities more to make the workforce better for our employees, which would make the overall quality of our products better. And lessons learned, we learned a lot of lessons from this simulation, but one of the lessons is we learned that customer service begins with serving your employees. When you have your customer service starts with good employee service. Employee satisfaction enables us to increase the bottom line profits, and it creates a lower chance of turnover, which is going to keep employees longer, which is going to help the company. And we learned that successful businesses take risks. Any successful businessman or business has to step out of their comfort zone and do things that they may not be sure of in order to be successful. And by that, I mean, we should have taken advantage of the investments. That's something that we all agreed on that we didn't do correctly, and that's what we should have taken advantage of with the risk there. And continuing on with our lessons learned, we learned that you can't ignore the competitor change. That's something that you have to constantly monitor. Monitoring your competitors it allows you to uncover new opportunities for your business. And we learned that a winning strategy isn't crafted in 1 or 2 weeks. It's something that you need to take a long time to strategize, and your strategy has to have longevity. It has to be something that you can stick with and increase over time. And probably one of the biggest lessons that we learned, we got a really good lesson on how to work together as a team and come together and how to overcome adversity, because things were pretty good at first, but we definitely encountered some challenges, and we really learned just how to work together as a team. We all had a bunch of crazy schedules, so we all had to, there's a lot of late night meetings, several meetings during the last 4 weeks in particular, where we were all over the place trying to meet almost every single day to make sure that we knew what we were doing. So it was a good experience, just learn how to bounce ideas off of teammates. We learned how to pick each other up and just get stuff done as a team.